Welcome back to the Deep Dive. Today, we are taking a closer look at a company that is absolutely central to the global supply chain, yet often operates entirely out of sight. Sysco Corporation, ticker SYY.
Yeah, it's funny. Food service distribution is one of those invisible giants, isn't it? It's just this massive undertaking happening behind the scenes. We're looking at a pretty detailed due diligence report here, and it estimates the global market is heading towards, well, something like $1.1 trillion by 2025.
$1 trillion.
It's
Nice.
huge. And right at the top of that heap, you've got Cisco. They're the clear global leader, reporting over $81 billion in net sales for their fiscal year 2025.
81 billion. Okay,
Awesome.
that scale is just, it's hard to ignore. So our mission here in this deep dive is really to tackle what seems like the core paradox of Cisco's business. I mean, this is famously a high-volume, low-margin industry, right?
Extremely low margin, yeah.
We're talking net profit margins, typically hovering between, 2 and 4%. So how does a company like this, making pennies on the dollar, manage to build such a strong, competitive moat and consistently generate, frankly, superior returns on invested capital?
That really is the million-dollar question, isn't it? Or maybe the $80 billion question here. If you're operating on such thin margins, you have to be incredibly efficient, just ruthlessly efficient. So we'll be using our source material today to really break down the four key pillars that seem to support the investment thesis.
Okay, what are those?
Well, first, their sheer overwhelming scale. You just can't overstate that. Second, the durable advantages they've built, particularly in logistics, but also increasingly in service. Third, how well they seem to be executing their recipe for growth strategy. And finally, that robust capital allocation framework, which is really focused on maximizing total shareholder return, or TSR.
Got it. Sounds like a plan. Let's start then by laying the groundwork in part one, the foundations of scale. Let's look at Cisco's actual operational blueprint and the structure of this market they operate in.
Right. So to really get Cisco, you have to picture the physical infrastructure. This isn't just, a few warehouses and some trucks. They operate roughly 339 distribution centers.
339.
Yeah, spread across 10 countries. And these centers allow them to serve something like 730,000 different customer locations. Think restaurants, hospitals, schools.
Wow.
And they've got 75,000 colleagues making this happen, managing these huge, complex networks of refrigerated trucks, specialized storage. I mean, this immense, tangible, physical infrastructure, that's the first major competitive advantage. It's a massive barrier to entry.
Right. You can't just decide to compete with that overnight. It would take decades, probably billions of dollars, just to replicate that physical footprint.
Exactly. Billions.
But the strategy, it seems, goes beyond just having the biggest network of warehouses and trucks, right? You mentioned service. They're actively trying to evolve, it looks like, from being just a logistics provider, maybe a low-margin one, to becoming more of an indispensable, high-touch service partner. What does that actually mean for, say, a restaurant owner using Sysco?
Well, it means they're trying to become sticky. That's the goal. This whole value-add strategy is really designed to create high switching costs.
Okay.
So it protects them from, maybe a smaller regional competitor who comes along and tries to undercut them by just a tiny fraction of a percent on, say, a case of tomatoes. Cisco wants to make leaving them much more painful than just saving a few pennies.
Okay, so what are those specific services then? What makes them sticky? How do they create that lock-in?
It really starts with integrating themselves into the customer's operations, both intellectually and technologically. So, for instance, Cisco provides culinary consulting. They help customers develop menus, cost them out, keep up with food trends. That's the intellectual part.
Right, a partner in the kitchen.
Sort of, yeah. But then, crucially, there's the tech side. They offer things like the Cisco portal. This is their platform for online ordering, but it also helps with inventory management, gives reporting tools.
Oh, okay, so it's more than just placing an order.
Much more. When a restaurant starts running its whole back-of-house operation, ordering, inventory counts, maybe even menu costing through Cisco's tech platform, switching distributors suddenly becomes a massive headache. It's not just finding a new supplier for flour. It might mean ripping out and rebuilding their entire operational system.
Right. That definitely thickens the moat, doesn't it? It's not just about the price of potatoes anymore. You're essentially telling the customer, look, our expertise, our tools, our integration, that's worth maybe paying a tiny bit more for the basic goods.
Precisely, yeah. It turns what could be a simple commodity transaction, I need 10 cases of chicken, into a much deeper integrated business relationship. And, if we look at how they break down their business segments based on the fiscal 25 data in our sources, you can actually see this strategy playing out. They're layering these specialized, higher value acquisitions onto their core business.
Okay, let's unpack that segmentation. That should give us a clearer picture of where the money's actually coming from.
Definitely. So the biggest piece by far is U.S. food service operations. That's the core, the behemoth segment. It accounted for $57 billion in net sales in fiscal 25.
$57 billion.
Yeah.
Just in the U.S.
Just in the U.S. And that includes their main broadline distribution, the bulk food, the staples. But importantly, it also includes these key specialty operations they've acquired. Companies like FreshPoint, which is dedicated just to produce, or Greco and Sons, focusing on Italian specialty items. And a more recent big one, Edward Don, for equipment and supplies.
So they're moving into non-food items too.
Absolutely. This move into specialty areas is really critical because those segments often carry better margins and maybe less volatile pricing than basic commodities.
So it's a deliberate strategy to move up the value chain wherever they can find an opening.
Exactly. Then the second major engine is international food service operations. That brought in about $14.9 billion in net sales.
Okay, still substantial.
Yeah, and this is seen as a really vital growth area for them. They're focused on expanding across Canada, Mexico, and parts of Europe. And generally, the consolidation trend in those markets isn't as far along as it is in the U.S., so there's maybe more room to grow.
More runway international.
Potentially, yes. And then finally, there's the other segment. This is mostly their SYGMA operation. SYGMA provides customized distribution specifically tailored for large national chain restaurants. Think big fast food chains, casual dining chains. That added another $9.5 billion in sales. It provides these really stable, high-volume contracts.
Got it. Okay, that breakdown is helpful. And it brings us, I think, to a really crucial structural feature of the U.S. market in particular, which you touched on, the fragmentation. We know Sysco is the leader, obviously, with that huge $57 billion U.S. segment. But I was actually surprised when I looked at the report by how much of the market they don't control.
Yeah, this fragmentation point, it's probably the single most important factor underpinning the long-term growth story for Sysco. The total U.S. distribution market is enormous. Our source puts it around $382 billion annually.
$382 billion.
Annually. But the big three, that's Sysco, U.S. Foods, and Performance Food Group, or PFG, collectively, they only control about 35% of that market.
Only 35%.
That's right. Sysco leads the pack with about 17% share. Then you've got U.S. Foods around 10% and PFG with roughly 8%.
Wait a minute. So doing the math, that means 65% of this massive market is still somewhere else. Who's actually serving that remaining two-thirds?
That massive 65%, that remaining chunk, is served by an estimated 12,000 smaller players. These are independent distributors, regional specialists, ethnic food suppliers, a whole constellation of smaller companies.
The 12,000.
Yeah. And generally speaking, these smaller players are just less efficient. They don't have the purchasing power. Sysco has to get good prices from suppliers. They don't have the route density. They often don't offer the kind of deep technological integration we were just talking about. So that huge 65% slice of the pie, served by thousands of less efficient operators, that's the primary long-term runway for Sysco. It makes structural consolidation almost inevitable.
And this must feed right back into that self-reinforcing cycle of scale you mentioned at the start. Let's just break down the mechanics of that cycle again, because this feels like where the low-margin commodity business somehow transforms into this high-return machine.
It really is all about efficiency at scale. So step one, Sysco's massive purchasing volumes, buying for 730,000 locations, allows them to command better pricing from their suppliers. That means lower cost of goods sold, or COGS.
Okay, better input prices.
Right. Simultaneously, because they have so many customers clustered together, they achieve vastly superior route density compared to a small regional player. Think about it. If a small guy has to drive 50 miles between 3 stops, and Sysco, in that same 50 miles, can maybe hit 20 stops because they have so many customers nearby, Sysco's costs for fuel, for driver labor, for truck maintenance all drop dramatically on a per-case delivered basis.
Lower input costs plus lower operating costs per delivery. That flows straight to the bottom line, even if the margins are thin.
Exactly. Lower COGS plus lower operating costs equals stronger gross margins and stronger operating margins than the smaller guys. And those stronger cash flows that result, they're then strategically deployed, often through M&A, to acquire those smaller, less efficient competitors.
Which makes Sysco even bigger.
further increasing their scale, their purchasing power, their route density, and the whole cycle starts again, reinforcing itself. This process, this consolidation engine, is what has successfully pushed the Big Three's combined market share up from around 28% back in 2015 to that 35% figure today. And the expectation is this dynamic will continue reshaping the industry for, well, probably the next decade or more.
Okay, that cycle makes a lot of sense. If we try to look at this structural advantage through a more academic lens, maybe like Porter's Five Forces, which helps us think about long-term industry profitability, where do the critical barriers to entry really lie? What stops new players?
Well, the threat of new entrants, according to the analysis, is seen as low to moderate, but probably leaning more towards low. And it really comes back to that massive capital hurdle we discussed.
Right, the infrastructure cost.
Yeah, forget just buying a few trucks. We're talking about building state-of-the-art, refrigerated warehouses, dealing with complex food safety regulations, setting up the sophisticated IT infrastructure needed to manage it all. Our sources estimate it could cost upwards of $250 million just to build and equip one modern distribution center.
$250 million for one warehouse.
Yeah, and that's before you even buy the fleet or stock the inventory needed to actually operate it. That sheer scale requirement is a huge deterrent for anyone thinking about starting from scratch.
And that massive capital expense gets compounded by the low margins, right? You need enormous volume right out of the gate just to service the debt on that initial investment.
Absolutely correct. It's a tough equation for a newcomer. Then if you look at the power of suppliers, that's also generally considered low. Why? Because Sysco is the biggest buyer by far. They wield significant leverage over a pretty fragmented base of food manufacturers, farmers, producers. They can demand good prices.
Okay, so low threat from new entrants, low power from suppliers. What about rivalry?
Rivalry among the existing players, that remains intensely high. You've got the big three, Sysco, U.S. Foods, PFG, all large, sophisticated, publicly traded companies competing fiercely on price, service, everything. Plus, you still have those 12,000 smaller regional players fighting tooth and nail for survival. It's that intense competition that keeps those net profit margins so razor thin, usually in that 2–4% range.
Makes sense. Intense competition keeps everyone honest on price. Now, the final piece of the puzzle. What about the threat of substitution? This feels like the big, maybe longer-term digital disruption risk.
Yeah, the threat of substitutes is rated as moderate to high, and it's definitely the most dynamic, the most uncertain risk Sysco faces looking forward. This threat comes in a few forms.
Like what?
Well, first, there's the possibility of restaurant operators bypassing distributors like Sysco entirely, maybe trying to do more direct purchasing straight from manufacturers or farmers. Second, you've got the rise of cash and carry wholesalers like Restaurant Depot, where chefs can just go and pick up supplies themselves, cutting out the delivery aspect. But third, and perhaps most critically long-term, is the threat from technology-enabled procurement platforms. Think about, potentially an Amazon business for restaurants or other specialized B2B platforms. If a new digital layer emerges that can efficiently connect, say, that 37.5% of operators reportedly looking at direct sourcing, if it can connect them directly with suppliers and manage the logistics somehow, that could fundamentally cut into Sysco's core business model.
Right, that disintermediation threat. It makes their own investment in technology, like that Sysco portal, not just a value add, but almost an existential necessity to defend their position.
Exactly. They have to be the best tech solution for their customers or risk someone else becoming it.
Okay, that's a great overview of the landscape. Let's jump into part 2 then and look at the recent performance scorecard. If we focus on fiscal year 2025, the report suggests the picture, particularly domestically, was maybe a bit constrained, even with that huge $81.4 billion top line.
Yeah, mixed is probably the best analytical word for FY25. On the one hand, yes, top-line sales grew 3.2% to hit $81.4 billion. And adjusted earnings per share, EPS, also grew, but only modestly, up 3.5% to $4.46 per share.
Okay, growth, but not exactly stellar growth.
Right. And the real core concern when you dig into the details was the underlying health of the main U.S. market. Their U.S. food service case volume, just the sheer amount of stuff they moved, only increased by a really modest 4–5% for the entire year.
0.5%. That's basically flat volume growth in their biggest, most important segment.
Pretty much flat, yeah. And that's definitely a major point of focus, maybe even concern for analysts looking at the company.
And I gather that stagnation wasn't even consistent through the year. There was some significant quarterly volatility that maybe highlighted the consumer struggling.
Yeah, the volatility was quite pronounced. According to the report, they saw Q3 of fiscal 25 experience a pretty painful 2.0% decline in U.S. volume. Management attributed that to a couple of things hitting at once. Some severe winter weather impacting restaurants, but also what they called an observable deterioration in consumer confidence, people pulling back.
Okay.
But then things did seem to stabilize somewhat. They saw a sequential rebound in Q4, where the volume decline moderated quite a bit, down only 0.3%, still down, but much better than Q3.
So a tough patch, then a bit of a recovery towards the end of the fiscal year.
Exactly. And the really interesting thing, the key takeaway here, is that despite this weak, almost flat domestic volume environment, Sysco still managed to grow earnings, albeit modestly. And that's what leads analysts to talk about this decoupling thesis.
Okay, explain that decoupling thesis again. How can they actually grow earnings if their core domestic volume, the amount of food they're selling, is basically stagnant? Where's the growth coming from?
It implies they're not just passively riding the waves of the U.S. market anymore. They seem to be actively manufacturing growth through internal strategic actions. They're focusing on things like improving their sales mix towards higher margin products, exercising superior cost control, and really leaning on the strength they're seeing internationally.
So less reliant on just overall market growth, more reliant on their own execution.
Precisely. It suggests a shift, and this is where their recipe for growth strategy becomes so absolutely vital. It's their playbook for controlling the variables that they can control, regardless of what the broader economy is doing.
Okay, so tell us about the key initiatives within that recipe. What are the main ingredients, so to speak, that are driving this manufactured growth?
Well, the plan, as laid out in the source material, is pretty integrated. It touches on four main areas: digital initiatives, products and categories, supply chain optimization, and empowering their customer-facing teams.
Let's start with digital. We talked about the portal, but what else?
On the digital transformation side, the big push is to use technology not just for ordering, but to drive efficiency and, crucially, customer loyalty. They have a Perks customer loyalty program, for example, designed to reward frequent ordering and deeper engagement. But probably the most interesting tool mentioned is this AI-powered CRM system they call the AI 360 selling tool.
AI 360. Okay, sounds fancy. What does that AI tool actually do for, say, a Sysco sales representative out in the field?
The goal is basically to make every sales interaction smarter and more profitable. The AI analyzes a ton of data in real time: the customer's order history, local restaurant trends, what similar customers are buying, maybe even external data. And based on all that, it predicts what a customer is likely to need next.
Okay, predictive ordering.
Yeah, but maybe more importantly, it identifies things the customer isn't currently buying from Sysco, but probably should be, based on their profile. It flags upselling and cross-selling opportunities, particularly for higher margin items, and pushes those suggestions right to the sales rep's tablet or phone. It's essentially trying to optimize every single customer interaction for maximum profitability.
Okay, so using data to nudge sales towards more profitable products.
Yeah.
That seems to tie directly into their strategy around M&A and focusing on specialty categories, right?
Yeah.
If the AI suggests a customer should be buying more fancy cheese or custom-cut steaks, Sysco needs to have those products readily available.
Exactly. They need the capability to deliver on those AI-driven suggestions, and that's where the acquisitions come in. They aren't just random roll-ups. Deals like buying the Coastal Companies in May 2024 for high-end produce,
Right.
or acquiring Edward Don for equipment and supplies in late 2023. These are very strategic tuck-in acquisitions. They're designed specifically to bolster those specialty, often higher growth and higher margin categories. It ensures that when the AI 360 tool flags an opportunity to sell, say, artisanal bread or locally sourced greens, Sysco actually has that product in its network and can deliver it efficiently.
So the M&A feeds the AI's effectiveness, and the AI helps sell the M&A products. It's another reinforcing cycle.
You got it. But, if we're looking for the real star performer during this recent period, the segment that truly validated the decoupling strategy while the U.S. was sluggish, it absolutely has to be the international engine.
That's what the report highlights pretty strongly.
Oh, absolutely. International delivered its 7th consecutive quarter of double-digit adjusted operating income growth in Q4 of fiscal 25. That's almost 2 years of consistent, strong growth. The performance internationally has been genuinely transformative for the overall profit picture.
Double-digit growth for 7 straight quarters.
Yeah, and consider this really striking figure from the report. Sysco's international profitability has effectively doubled over the last 2 years.
Yeah.
Doubled.
Wow. That is massive, especially given the flatness in the U.S. That kind of growth provides a serious counterweight, a much-needed ballast when the core U.S. market is basically sputtering along.
It really does. It shows the geographic diversification strategy is paying off.
Okay, now let's talk about the product mix itself. Within the U.S. especially, there seems to be a big strategic push into private label products, the Sysco brand. How central is that to their margin expansion plans?
Oh, it's absolutely fundamental. This is a long-term secular trend that really favors large distributors like Sysco. We're talking about products sold under Sysco's own brands, Sysco Classic, Sysco Supreme, etc.
Right. Why is that so important for margins?
It's simple economics, really. These private label items typically carry significantly higher gross margins for Sysco than the equivalent national brand products they also distribute. Think about it. When Sysco sells, say, Heinz ketchup, they make a distribution margin. When they sell their own Sysco brand ketchup, they capture not just the distribution margin, but effectively the manufacturer's margin as well.
Ah, okay. So they capture more of the value chain for themselves.
Exactly. And it's a double whammy, potentially, because not only do they make more profit per case on private label, but these brands can also foster greater customer loyalty. If a chef gets used to the quality and consistency of a specific Sysco brand product, they're less likely to switch distributors just to get a slightly cheaper national brand alternative.
Assuming the quality is there, of course.
Assuming the quality is there, yes. And Sysco invests heavily in ensuring that. The current penetration rate is already pretty significant. According to the Q3 FY25 data, private label products represented 35.5% of all U.S. broadline cases sold.
Over a third.
Yeah. And analysts cited in the report project that this growth in private label is likely to account for a majority of the total industry value growth over the next 5 years. It's a massive tailwind for Sysco and its peers, but actually a headwind for the traditional branded food manufacturers.
Interesting dynamic. Okay, time to pivot then to part 3. Navigating the headwinds. We've established that Sysco's internal execution seems pretty strong, the strategy makes sense, but they're obviously not immune to what's happening in the broader economy. What are the key macro challenges hitting them right now, according to the report?
Well, the biggest, most immediate challenge seems to remain consumer weakness. The data is pretty clear. Restaurant traffic overall declined 3.1% in the calendar quarter ending March 2025.
People eating out less.
Eating out less or changing how they eat out. Management talks about consumers becoming very value conscious. That means they're either cooking more meals at home to save money, or when they do dine out, they're trading down, maybe choosing a cheaper restaurant, ordering fewer appetizers or drinks, looking for deals.
And the independent restaurants, which we identified as Sysco's most valuable, highest margin customers, they're probably the most vulnerable to that trade down effect, right? Chains often have more resilience.
Precisely. Independent restaurants, which apparently make up about 59% of total industry sales, they feel that pullback much more acutely. When their traffic drops or when their customers order less profitable items, it hits Sysco's case volume and their profitability directly. It's a major sensitivity.
Okay, so consumer weakness is number one. What else of it?
We also have just pervasive inflationary pressures. Even though inflation has cooled from its peaks, it's still present. Sysco's own internal measure of product cost inflation was running at 2.5% in fiscal 25.
Still having to pay more for the goods they buy.
Exactly. Now, distributors like Sysco are usually pretty adept at passing those costs along to their customers through price increases. But there's always a risk, right? If they have to push through repeated price hikes, it could accelerate that consumer weakness, make dining out even less affordable, or potentially encourage some customers to shop around more aggressively for lower-cost suppliers, even if it means less service.
It's a delicate balancing act. Pass on costs, but don't kill demand.
It really is. And then the high cost of actually doing business remains a constant challenge, particularly around labor dynamics.
Right, wages and staffing.
Yeah. The labor market, especially for roles like delivery drivers, remains persistently tight and competitive. This drives wage inflation, making it more expensive to hire and retain the people needed to run those complex logistics networks. And it also creates potential staffing shortages.
And for a business built on dense, efficient delivery routes, the cost of labor must be enormous.
Huge. The report mentioned that delivery driver compensation in this industry averages over $70,000 per year. Managing that wage pressure, finding enough qualified drivers, doing it all without sacrificing service quality, it's a continuous operational headache, even for a giant like Sysco with all its efficiencies.
70,000 average for drivers.
Yeah.
Wow. Okay. And then we should circle back quickly to the technology threat. The possibility of technology disruption still looms as that longer-term structural risk that could potentially disintermediate the whole business model.
It really is the existential question mark hanging over the industry. Is some venture-backed startup, or maybe even a major tech platform like Amazon or Google, could successfully build user-friendly procurement tools that allow restaurants to efficiently source directly from suppliers and maybe handle the logistics differently? Then Cisco's massive physical infrastructure, currently its biggest moat, could potentially become more of a liability, an expensive legacy asset. The fact that the report mentions nearly 40% of restaurant operators are at least exploring direct sourcing options tells you this isn't just theoretical. Cisco has absolutely zero room for complacency when it comes to investing in and improving its own digital offerings. They have to remain the easiest, most valuable way for restaurants to buy things.
Okay, so those are some significant headwinds. Consumer health, inflation, labor costs, and the ever-present tech disruption threat. Despite those hurdles, though, the report seems pretty clear that the avenues for future growth for Cisco are still remarkably clear, and they stem almost entirely from that industry structure we talked about earlier.
Yeah, the paths forward are pretty well defined. Opportunity number one, the biggest one, remains that consolidation runway.
Right, the 65% of the market still served by smaller players.
Exactly. Cisco's current 17% market share, while dominant, still means there's this huge slice of the $382 billion market being served, often less efficiently, by those 12,000 smaller competitors. This provides a multi-decade growth pathway where Cisco can continue to gain share, either through ongoing M&A, buying up regional players, or simply by outcompeting them organically with better pricing, service, and technology.
So just keep executing the playbook.
Pretty much. And that organic growth piece is being actively fueled by their strategic focus on those higher margin areas we mentioned, the specialty categories.
Okay, tell me more about that. How big is that opportunity?
Well, management explicitly sees a clear, addressable growth opportunity worth more than $10 billion just within specialty categories. Things like high-quality fresh produce, custom-cut proteins, imported-up ethnic foods, gourmet cheeses, areas where prices may be less sensitive and service matters more.
And how are they actually going after that $10 billion? What's the strategy?
They have a specific approach they call total team selling.
Total team selling. Okay, what does that look like in practice on the ground?
It's actually quite tactical and smart. Instead of just having one generalist broadline sales rep trying to sell everything from ketchup to cleaning supplies to caviar,
Right.
they pair the broadline account manager, who handles the day-to-day commodity orders, with a dedicated specialty expert. So you might have a produce specialist or a protein specialist or a European foods expert who comes in alongside the main rep.
Ah, bringing in the specialist.
Exactly. These two individuals then collaborate. They work together to identify opportunities and drive high-margin cross-selling into that existing customer base. The broadline rep maintains the relationship. The specialist brings the deep product knowledge. The goal is to maximize the revenue and profit generated from every single customer stop, every single relationship.
That makes a lot of sense. Leverage the existing customer base more effectively.
Yeah. And then, of course, we also can't forget the international expansion piece.
Right, the star performer recently.
Yeah.
The international segment is basically just taking this successful U.S. consolidation playbook and applying it to less mature markets abroad. They're leveraging their global scale to push Cisco brand private label penetration internationally, and they're pursuing targeted tuck-in M&A to gain footholds or strengthen positions in specific countries. And as we saw, the performance validation is already clearly there with that doubling of international profitability over the last 2 years.
Okay. And one last growth area mentioned?
Yeah, a slightly different angle. Growth in what they call defensive channels. These are non-commercial segments. Think like healthcare facilities, hospitals, nursing homes, educational institutions, schools, universities, maybe government contracts.
Why are those important? Because spending in these segments tends to be much less sensitive to the ups and downs of consumer discretionary spending. People still need to eat in hospitals and schools, even during a recession. So growing in these defensive channels provides a really valuable stability, a ballast for the overall business, helping to smooth out earnings when the core restaurant business inevitably faces cyclical headwinds.
Got it. Diversification within their customer base.
Yeah.
Okay, let's shift gears completely now and dive into part 4, financial strength. Because this is really where we need to uncover the mechanism behind that paradox we started with. How does this low-margin business generate such high returns? We know Cisco's revenue has shown resilience, growing steadily from about $50 billion in 2016 to that $81.4 billion in 2025.
Right. And that revenue resilience is really underpinned by some serious operational excellence. And the best way to measure that, to see the quality of the operation, is through return on invested capital, or ROIC. This is probably the single most important metric in the report for understanding Sysco.
Okay, ROIC. What is Cisco's number?
Cisco's ROIC, according to the source, is strong. Very strong, actually. It's running at 15.6%. This right here is your aha moment. This is how you understand the underlying quality and efficiency of this business, despite the thin net margins.
15.6% return on all the capital they've deployed, debt and equity. How dramatically does that actually separate them from their main competitors, U.S. Foods and PFG?
Oh, it's not even close. It's more like a canyon than a gap. Cisco's 15.6% ROIC puts them ahead of nearly 95% of the entire industry. To put it in really stark contrast, U.S. Foods, their closest large competitor, operates with an ROIC down around 8.0%.
Okay, roughly half.
Roughly half, yeah. And Performance Food Group, PFG, the other big player, their ROIC is even lower, closer to 5.5%. So Cisco is generating almost twice the return on capital as U.S. Foods and nearly 3 times the return of PFG.
Wow. Okay, that 15.6% ROIC really does prove that the scale advantages, the operational discipline, the route density, it's all actually working and translating into superior capital efficiency. That's compelling. But I also saw another return figure in the report that jumped out at me, an extraordinarily high return on equity, ROE, somewhere close to 100%. That seems almost too good to be true, unsustainably high. Is there a catch there?
Yes, there is definitely a catch there, and it's really critical for anyone analyzing Sysco to understand this distinction. While that fantastic 15.6% ROIC is a genuine testament to their operational quality and efficiency, that super high ROE number, close to 100%, is largely an accounting artifact. It gets massively amplified by Sysco's significant use of financial leverage, meaning debt.
Ah, okay. So ROE is net income divided by shareholder equity.
Yeah.
If a company funds a large portion of its assets using debt instead of equity,
Then the denominator in that ROE calculation, the shareholder equity part, becomes much, much smaller relative to the asset base.
Right.
So even with a solid but not astronomical net income, if you divide that net income by a relatively small equity base, the resulting ratio, the ROE, mathematically skyrockets. It can look artificially impressive.
So while Cisco is definitely generating great returns, we should focus on the ROIC, 15.6%, as the core measure of operational performance because it includes both debt and equity capital. And the high ROE mainly tells us they use a lot of debt in their capital structure.
That's exactly the right way to look at it. The ROIC shows the quality of the business operations. The ROE reminds us that debt plays a very significant role in how they finance those operations.
Got it. Okay. Nonetheless, leverage or not, they are clearly a phenomenal cash flow machine. What does their cash generation capability actually look like year to year?
It's extremely robust and, importantly, quite predictable. They generated $1.8 billion in free cash flow, FCF, in fiscal year 25. And management is explicitly targeting generating over $2 billion in FCF annually going forward.
$2 billion plus in free cash year after year.
Yeah. And there's another crucial detail in the cash flow statement that suggests good financial health. If you look at their numbers, their net income, $1.83 billion in FY25, consistently runs lower than their cash flow from operations, $2.51 billion.
Okay, why is that difference significant? Why is it good the cash flow is higher than net income?
It generally indicates that they aren't relying on aggressive accounting assumptions or non-cash earnings, like certain kinds of revenue recognition or depreciation gains, to prop up their reported profit number. They are generating hard, tangible cash faster than they are booking paper profit under accounting rules. That's usually a strong signal of conservative and healthy financial reporting. No big negative divergence there.
Okay, so they generate vast amounts of predictable real cash flow.
Yeah.
How does management then prioritize deploying all that cash? What does their disciplined capital allocation framework look like?
They operate with a very clear, publicly stated, three-pronged hierarchy for using their cash. It's quite disciplined. Priority number 1 is to reinvest for growth. This means capital expenditures, CapEx spending on maintaining and upgrading their warehouses, their truck fleet, their technology. They typically target CapEx at around 1% of their total sales.
Okay, reinvestment first. What's second?
Priority number 2 is to maintain a strong balance sheet. Specifically, they aim to keep their financial leverage, measured as debt to EBITDA, within a target range of 2.5x to 2.75x. Sticking to this range is crucial for maintaining their investment-grade credit rating, which keeps their borrowing costs low.
Right, managing the debt. And the third priority, this must be the one crucial for shareholders.
It absolutely is. Priority number 3 is to return capital to shareholders, and their explicit policy is to return essentially all remaining free cash flow to shareholders after they've covered their CapEx needs and any debt management requirements.
All remaining cash back to shareholders.
Wow.
And those returns in fiscal 25 were pretty substantial, right? About $2.3 billion in total.
That's right. $2.3 billion returned in FY25. And that was split between $1.0 billion paid out as dividends and another $1.3 billion used for share repurchases, which also returns value by reducing the share count.
Okay, and the dividend itself is a huge distinguishing factor compared to their peers, isn't it?
Massive difference. Sysco's current dividend yield is running around 3.0%. And maybe even more impressively, they boast a truly remarkable 56-year track record of consistently increasing that dividend year after year.
56 years of dividend increases. That speaks volumes about the stability and predictability of their cash flows, doesn't it? Even if the margins are thin day to day. It's also really important to note, as the report does, that neither of their main peers, U.S. Foods or PFG, currently pays any dividend at all.
Yeah, that dividend is a key feature. It really defines Sysco more as a steady, reliable, total return play, rather than purely a growth stock like its peers might be seen. And management has actually crystallized this whole philosophy into a clear target for investors. They call it the Target Total Shareholder Return, TSR algorithm.
Okay, a TSR algorithm. What is the target they're aiming for?
They explicitly target delivering an annual total shareholder return that's share price appreciation plus dividends of between 9% and 11%.
9 to 11% per year.
That's the goal. And they even break down how they expect to get there. They anticipate 6% to 8% of that TSR coming from underlying EPS growth, driven by consolidation, efficiency gains, etc., plus that additional 3% contribution coming directly from the dividend yield.
That level of transparency is pretty admirable, actually. They're essentially giving investors a clear roadmap for how they expect to generate returns over time.
It is quite clear, yes. Shows confidence in their model.
Okay, let's touch briefly on governance before we get to valuation. The current strategy, the recipe for growth, is largely credited to the CEO, Kevin Hurricane, who came on board a few years ago. How is management's compensation aligned with actually delivering on this strategy? Are their interests aligned with shareholders?
The alignment appears pretty strong based on the report. Hurricane, who joined in 2020, brought extensive experience in managing large-scale, complex operations from his time at CVS Health. And his compensation, along with other top executives, is heavily tied to performance metrics. The report notes that in fiscal 24, a full 91% of the CEO's total compensation was performance-based, not guaranteed salary.
91% at risk.
Yeah. Furthermore, there are requirements for executives to build up and maintain significant personal ownership of Sysco stock. This ensures their own financial interests are directly aligned with achieving long-term share price appreciation and TSR for all shareholders. Skin in the game.
Okay. And plus, the board structure seems to provide a decent level of independent oversight.
It appears so. The report highlights the existence of a lead independent director, currently Larry C. Glasscock, who acts as a counterweight to the CEO chairman role. And they have pretty comprehensive corporate governance guidelines in place, including things like a 15-year tenure limit for non-employee directors, which helps ensure some fresh perspective and independent challenge to management decisions over time.
Good governance checks and balances. Okay, that brings us perfectly to part 5, which frankly is the most fascinating part of this whole deep dive for me.
Yeah.
The valuation paradox. We've established Sysco as the clear market leader. They generate industry-crushing ROIC. They have a 56-year dividend growth streak. So why on earth does the stock consistently trade at a significant discount to its main peers, U.S. Foods and PFG?
This disconnect, this paradox, it really is the crucial debate for anyone considering an investment in Sysco. Let's just lay out the numbers again based on the late 2025 data in our source. Sysco trades at a price-to-earnings PE ratio of about 21.0x, and its enterprise value to EBITDA multiple is around 12.0x.
Okay, 21 PE, 12 EBITDA. Now compare that to the peers.
Right. The comparison is really stark. U.S. Foods, ticker USFD, is trading at a PE multiple of 32.5x.
Considerably higher.
Yeah, and its EBITDA is 13.6x, also higher than Sysco. But then look at Performance Food Group, PFGC. It's trading at an even loftier PE multiple of 47.3x.
47 times earnings. Wow.
Yeah, and its EBITDA multiple is up at 15.9x. So there's no question the market is clearly applying a pretty meaningful valuation penalty to Sysco, the undisputed market leader with superior returns. The big question is why? We need to look beyond just the simplistic answers here.
Okay. The two primary reasons you often hear cited are, one, the size penalty, big companies just grow slower, and two, the recent sluggishness in U.S. volume growth we talked about. Are those really enough to justify such a wide valuation gap, especially given that ROIC difference?
Well, they are definitely contributing factors, but maybe they don't tell the whole story. Yes, it's true. The market often penalizes large dominant companies like Sysco because their structural growth potential is perceived to be slower than for smaller, nimbler players like PFG, which can maybe grow faster just by playing catch up and consolidating smaller pieces.
The law of large numbers.
Exactly. And yes, that recent weakness in U.S. case volume absolutely creates some pessimism. It raises legitimate questions about the health of Sysco's core independent restaurant customer base and the near-term outlook. Investors might be hesitant.
But let's challenge that logic for a second. If Sysco is generating nearly twice the return on invested capital of U.S. foods and almost 3 times that of PFG, shouldn't its superior operational efficiency, its proven ability to generate more profit from every dollar invested, actually merit a valuation premium, not a discount? What other factors, maybe structural or behavioral, could be at play here suppressing Sysco's multiple?
That's a great question. One potential structural factor we haven't emphasized enough yet is that high debt load we discussed earlier. Sysco carries about $12.9 billion in financial leverage on its balance sheet.
$12.9 billion in debt.
Yeah. Now, the company is highly cash generative, manages it well within its targets, and the Altman Z score, mentioned in the report, 5.15, suggests extremely low near-term bankruptcy risk. But still, that sheer quantum of debt might make the stock inherently less palatable to certain types of investors, maybe more conservative, low volatility-focused institutional funds. They might prefer the perceived higher growth potential of a less levered PFG, even if its underlying capital returns, ROIC, are much lower.
That's a really interesting point. The debt level itself acts as kind of a soft barrier, maybe preventing certain pools of capital from buying Sysco, which keeps the valuation lower than it otherwise might be.
It's certainly plausible it could be contributing. Another possibility is simply market skepticism about the sustainability of Sysco's internal strategy, the recipe for growth. Meaning, investors might look at the strong international growth and the gains from private label penetration and worry that these are just temporary fixes, maybe good margin boosters for a few quarters, but that they won't be enough to hold up if the U.S. consumer recession deepens significantly. They might be questioning whether that 9-11% target TSR is truly achievable if core domestic volume growth remains stuck near zero for a prolonged period. The discount, in this view, reflects a kind of show-me mentality from the market regarding the continued success and durability of the recipe for growth. They need more proof.
Okay, so a combination of size, recent volume concerns, high debt levels, and maybe some skepticism about the sustainability of the internal initiatives. That helps explain the paradox better. Let's try to synthesize the core arguments then. For the investor looking past the current valuation discount, what does the bull case really boil down to?
The bull case rests on several strong pillars, I think. First, you have Sysco's dominant market leadership in a structurally consolidating industry. They are perfectly positioned, better than anyone, to capture value from that long-term trend, which is still only about 35% complete in the U.S. Second, they have demonstrated proven strategy execution, particularly validated by that massive turnaround in international profitability and the aggressive, successful expansion into higher margin specialty categories using approaches like total team selling. They're showing they can manufacture growth.
And the third pillar?
And critically third, they offer reliable capital returns. That transparent 9-11% target TSR, backed by that incredible 56-year dividend growth record, provides significant downside protection and a clear path to returns, even if the share price itself doesn't dramatically re-rate higher immediately. It's a compounding machine.
Okay, that's a compelling bull case. Now, on the flip side, what is the clear bear case? What are the primary risks that investors absolutely must monitor if they're considering Sysco?
The bear case really centers on three main points. First, the high macroeconomic sensitivity. If consumer discretionary spending gets seriously cut back, restaurant traffic drops further, and Sysco's volume is inevitably the first casualty. Their fortunes are tied to people eating out. Second, there's the risk of persistent sluggishness in those core U.S. independent restaurant case volumes. If this weakness continues for too long, it might suggest deeper issues, maybe market saturation in some areas, or even permanent structural shifts in dining patterns post-pandemic that the company simply can't offset entirely through internal measures.
Right, the fear that the U.S. market is just fundamentally weaker now.
Exactly. And third, we must always circle back to the significant financial leverage, that $12.9 billion in debt. While Sysco is a cash machine and manages it prudently, that amount of debt undeniably amplifies financial stress considerably during any severe or unexpected economic downturn. It reduces their flexibility.
Okay, bull and bear cases, clearly defined. That makes monitoring the key catalysts absolutely essential. What specific data points or trends should you, the learner, be watching for in the coming quarters to see which case, bull or bear, is actually winning out?
I think there are 4 key things to watch. Number 1, absolutely the most immediate catalyst, is seeing a sustained positive return to growth in domestic volume, especially in that crucial local independent restaurant channel. If that number stays stuck near zero or goes negative again, the stock will likely remain under pressure.
Okay, domestic volume first.
Second, you need clear verification on the margin trajectory. Are the productivity gains, the cost management initiatives, the private label penetration, are they successfully offsetting inflationary pressures and the intense competitive environment? Are margins holding up or expanding? Third, you have to keep monitoring international profitability. If that consistent double-digit operating income growth starts to falter, then that whole decoupling thesis starts to look invalid and the pressure shifts back to the U.S. market.
Makes sense. And the last one.
And finally, you need to watch the execution risk, particularly around the technology rollouts. Keep an eye out for updates on the adoption rates and, more importantly, the measurable efficacy of tools like that AI 360 Sell-in platform. Is it actually driving the intended margin mix improvement and sales uplift? Or is it just a nice-to-have? Execution on these strategic initiatives is key.
Excellent. So this deep dive has really provided a remarkably clear picture of Sysco. I think it's this fascinating business that takes what seems like a basic, essential, low-margin utility service, delivering food, and through just unparalleled scale, relentless operational efficiency, and smart strategic deployment of capital, manages to transform it into a highly profitable, high return on capital enterprise.
It really is the ultimate business school case study in operational efficiency and the power of scale in a fragmented market. And Sysco's underlying financial health does appear resilient. You mentioned that Altman Z-score of 5.15, which signals very low near-term bankruptcy risk. However, you hit on a key point. The business model demands perpetual motion.
Perpetual motion.
Yeah. To justify the high financial leverage they employ, and crucially, to maintain that significant ROIC leadership over their peers, which is arguably their main claim to quality, Sysco must constantly be acquiring, integrating, and consolidating market share. They have to keep that scale engine running and growing. The moment that consolidation flywheel significantly slows down, the financial pressure could mount very quickly.
Which brings us perfectly to our final provocative thought for you, the listener, to chew on after this deep dive. Sysco's recipe for growth strategy is comprehensive, it's logical, but it relies heavily on manufactured internal strength, better execution, smart M&A, private label gains. The big question for you to consider is this. Can those internal gains, particularly from specialty categories, private labels, and continued international expansion, truly and successfully overcome a scenario of a sustained, significantly weakening U.S. consumer who simply stops dining out as much?
Right. Or will the persistent domestic volume challenges eventually force Sysco into a more painful reliance solely on continuous cost cutting? And if they have to cut costs too deeply, does that potentially start to erode the high-touch service and technological integration that currently defines their competitive moat, making them look more like a simple commodity provider again?
It highlights that unique, high-stakes trade-off inherent in trying to lead and dominate a massive but fundamentally low-margin, high-volume industry like food service distribution.
It really is the difference between being a reliable, predictable utility stock, maybe generating that solid 9–11% TSR, versus being perceived as a true growth machine that deserves a higher valuation multiple. And right now, Sysco seems to be walking a very, very fine line between those two identities.
A fascinating balancing act indeed. That's it for this week's Deep Dive. We'll catch you next time.